Hi, my name is Ray Noble, and this is the Business Growth Levers Masterclass. This masterclass is about how understanding your numbers can bring you more profit and cash without having to sell more. So grab a pen, some paper, real quick, and let's burn some rubber. Imagine you're visiting your friendly bank manager, and there are the usual difficult questions about your financial statements. As if it isn't bad enough needing the money, it's awkward for many business owners to have a conversation about their numbers. Would you sit there with a blank expression, or would you give explanations that showed you knew the real health of your business and were a reliable person for loans and overdrafts? What if you were so comfortable with financial concepts that you could negotiate confidently with clients, suppliers, investors, and bank managers? What if you could end the sleepless nights worrying about paying the bills and whether you will have the money to pay your staff and yourself at the end of the month? What if you could easily pinpoint areas for cost savings right across your business and hence make better decisions grounded in reliable financial data? This masterclass is for you if you want to stop worrying about cash flow, improve your profits and increase the value of your business. Well, here's what we're going to cover. Firstly, the question many people ask, how come I have nothing in the bank? Then, how do I make a profit? Thirdly, what is my business worth? And to wrap up, we'll have a Q&A. Before that, let's get things into context. So the big question is, why learn about numbers and finance? You may have heard the saying, finance is the language of business. If you understand money, then you gain control. You stop having unexpected money problems and you make better decisions. You then gain your freedom because you get your money working for you instead of chasing it all the time. A lot of business owners think that the numbers are for the accountant or the tax people. Think of any big company or corporation. The managing director or CEO in the States can always understand the numbers, and yet they've got a financial director and accountants who are very highly qualified, but they still understand the numbers for themselves. For me, the important thing about understanding numbers is the sheer and utter waste. A lot of bankruptcies and insolvencies could be avoided. At the moment, the UK is running at about 100,000 bankruptcies and insolvencies per year. That's a lot of waste. Why do all those businesses fail? There is a study by Entrepreneur Weekly, along with a small business development centre and a couple of universities, that came up with the fact that 46% of businesses fail because of incompetence, 30% due to an unbalanced or lack of managerial experience, and 11% due to a lack of experience of goods and services. I thought I'd better dig a bit deeper because this sounded a bit weird. It seems, as I got into the article, they explained what they meant by this 46% incompetence. It was to do with emotional pricing, living too high for the business, or spending too much, non-payment of taxes, yeah, that's pretty incompetent because the taxman can be very unforgiving, no knowledge of pricing, lack of planning, no knowledge of financing. They're all related to money and understanding the numbers. What about the 30% lack of management experience? When I looked into that, poor credit granting practices, expanding too rapidly, and inadequate borrowing practices. They all sound to me like they're money related as well. The final one was under the heading not understanding the goods and services. There, they said the key was wasted advertising budget. If you waste your advertising budget, it's usually because you don't understand the numbers. That makes close to 87% of businesses that fail being directly related to the lack of understanding of money and numbers. It's a really sad situation since it could be so easily avoided. From an early age, I wanted to be a chartered accountant. I spent 4 years working and studying, and that was about 3,000 hours studying to qualify. I'd been working for another 3 years when I finally got to understand what cash flow problems were. In that time, I'd prepared a lot of profit and loss accounts and balance sheets, and I knew what cash flow problems looked like on paper, but this didn't give me the true feel for what it was like to really experience it. Then I was sent out to help a client that was in financial trouble. They had one customer that was 80% of their sales, and they had been delaying payment for some time. They were a profitable company, but they'd maxed out their bank loans and their overdrafts and cut costs and turned delaying payments to suppliers into a real art form. They were constantly struggling to get the money to pay the staff. Each pound collected had to be used as effectively as possible to keep the business operating. That's when it hit me that there were jobs at stake here, families to feed, mortgages to pay, and these were real people I'd met and liked. They were worried they would not have a job next week or next month. And of course there were other people's businesses that were also on the line, as a business going under causes a ripple effect. I knew I wanted to help businesses become stronger and more resilient through understanding the numbers. I joined KPMG to get some broader experience, then Deloitte for 4 years, then I joined Digital Equipment Corporation for 7, followed by Danzas and Eddie Press, where I was financial director, and I spent 7 years. I went from accounting to auditing to financial management and then became a financial director. Since leaving the corporate world, I've started my own businesses, 2 of which I've closed, and now I'm a coach and mentor. And that's my wife. We work together. And we've also written a book called Business Growth Levers, which you'll get a digital copy of for attending this masterclass. Now you may be wondering why I'm putting a picture of a car. Well, it isn't just any car. This is a Noble M15, an incredible car. It does 0 to 62 miles an hour in 3.5 seconds. I would love one, but owning one is illogical. Why would you want to go from 0 to 62 quite so fast? It would be cool to have a fantastic car that had the same name as me. Anyway, I digress. I really love cars and driving, and most people can relate to cars. So all the way through, when I teach, I use metaphors that focus on cars. Your business is like a car with you as the driver. There's no point having the engine, that's the sales, if you don't have wheels on your car. So let's get on to learning something now. The big question, how come I have nothing in the bank? This is something a lot of my clients ask me when we first start working together. Where did all the money go? There was a survey of businesses that came up with a shocking statistic. Over 80% of businesses are running on empty. They are either constantly or frequently facing cash flow problems. Many people don't understand that cash doesn't equal profit or profit equal cash. So I get the question of how come I'm making a profit and I've nothing in the bank? Where did all the money go? I love accounting, but the financial statements aren't that easy to explain. Accountants like to use jargon and have many different words for the same thing, which often get misused or misleading. I think since you are in business to make a profit, you should be looking at a profit and loss statement and not call it a revenue statement or income and expenditure statement. After all, what's the main thing you want to know? Have you made a profit? The second one, the balance sheet, I like. It is what it is. But I don't like the source and applications of funds statement. Why can't it be called a cash flow statement? Fasten your seatbelts, because I'm now going to explain how these three financial statements fit together so that you can understand how it's possible to have no money in the bank but have a profit. It's all to do with the cash cycle. Suppose on day one we order some raw materials. This does not affect the profit and loss. It doesn't affect the balance sheet or the cash flow. We've just placed an order. Then on day 10, the raw materials are delivered. We have a transaction that we need to record in the books of 50. Well, it's really 5,000. I've left the last 3 zeros off to save ink. We have an asset of 50 in the inventory that we own and a liability of 50 that we owe to the supplier. So when we look at our books, we see no change in the profit and loss, and the balance sheet now shows the materials coming into inventory and the amount we owe to suppliers. And because we owe it to suppliers, here I've shown it as a negative, and the balance sheet balances. Don't freak out. I sneaked in the basis for debits and credits there. What we own and what we owe. There's no effect on the cash flow. 30 days later, we write out a cheque for 50,000 to pay those suppliers, which eliminates the amount we owed. Hence, it's a debit, and we reduce our cash. Let's suppose we have an overdraft, so we owe the bank now, which is a credit. How does that look in the books? Still no change to the profit and loss. The balance sheet still balances because now we have inventory of 50 and instead of suppliers we have cash of minus 50. We use that raw material and we produce some goods with some labour that now needs to be paid. And the price for that labour for the production is 30. That means we increase inventory by 30 and we decrease cash. Still no change to the profit and loss. Now we still have a balance sheet that balances since the inventory has increased by 30 to a total of 80 and the overdraft has also been hit with another 30, making it now minus 80. And that's also reflected in the cash flow statement, also at minus 80. Then we find a client who takes the goods. We sell them for 120. That means we have that money to come from the client, an asset, and the sale to record in the profit and loss, which is a credit. At the same time, we have to adjust our inventory because we no longer have those assets. So we take them out and put them into cost of goods sold in the profit and loss. Now finally we have some entries in the profit and loss account. The sale for 120, don't worry, it appears as a negative. This is to track the debits and credits, and the cost of sales of 80. They came out of the inventory in the balance sheet. If we were to close the accounts at that date, we would calculate the profit of 40 in the profit and loss account, and we would show the profit is being owed to the shareholders in the balance sheet, so it would still balance. On day 100, we have a profit of 40, but we still have negative cash. Now's the moment you've been waiting for. It's only when we actually collect the money 60 days later that we can say the sale has really taken place. The 120 of cash coming in is an asset that clears the overdraft, and we reduce the amount due to us by clients. All of a sudden, cash flow is positive, and actually in this case it matches the profit. It is just 60 days late. Obviously, I've ignored expenses for running the business in order to keep the example simple. This cash can be a temptation for the business owner who goes out and buys a Noble M15 or goes on vacation, usually forgetting to put the tax aside in a separate account. Now you see, profit doesn't equal cash because of timing. You account for each transaction when it happens, and selling goods is a separate transaction from actually collecting the money, unless you sell for cash. If you have to pay suppliers before you receive the money from clients, you will always have the need for more cash to grow your business, unless it is very profitable and you don't take those profits out as bonuses. Actually trying to grow the business because of timing can be the reason why a lot of businesses fail. All it may take is a major customer delaying payment to kill your business. So that's how come I've nothing in the bank. Next, how do I make a profit? What's important to know about how to make a profit is understanding the relationship between the income, the variable costs, and the fixed expenses. This is the example of a restaurant I was going to open. I've used round numbers to keep things simple. I expected the average meal price to be around £20. The food cost per meal to be around £8. Seating capacity, well, not too many, only 60. The monthly expenses for things like rent, staff, licenses, electricity, gas, etc., they came to £15,000. Now, being a numbers guy, I did a graph of monthly revenue and costs versus the number of meals sold. First, I plotted the fixed expenses of 15,000, which were a horizontal grey line, because it didn't matter if we sold one meal or 2,000 per month, they were unlikely to change much. The horizontal axis is the number of meals sold. Next, I put the line for the meal costs plus the fixed expenses is the brown line that starts from 15,000. Next, the blue line for sales, which obviously starts at 0. Where the blue line for sales and the brown line, total costs and expenses, cross is where sales equal total costs and expenses. As you see, this is the break-even point, which happens to be at 1,250 meals. I made a summary profit and loss account with sales of £25,000, which is 1,250 meals at £20 each, and the cost of sales £10,000, which is the same number of meals multiplied by £8 each, and that gives me a gross profit of 15,000, which is equal to the expenses, which is my net profit, or in this case, my break-even of 0. Just to prove the numbers are correct, I put it into an equation. I knew my expenses were 15,000, so I substituted that in the equation and took it to the other side. I then substituted the sales with the meals times £20 each and the cost of sales with meals times £8 each. Everyone good so far? Meals times £20 minus meals times £8 is the same as meals times bracket 20 minus 8. Okay? So divide both sides of the equation by bracket 20 minus 8 and we get 15,000 divided by 12, which is 1,250, which means I have the correct number of meals. 1,250 meals per month is a bit hard to imagine, so let's break that down by day. Suppose the restaurant is open 25 days per month on average, then that works out at a nice round 50 meals a day. But I don't just want to break even, I want a profit. I want a return on my investment. And let's suppose I want £5,000 per month. I'd call this my ideal profit. Working backwards, if I want to get a net profit of 5,000, my gross profit would be 20,000. So now I have to work out my sales and cost of sales. Now in the formula, the meals times £20 minus the cost of meals, that's meals times £8, equals 20,000. So meals equals 20,000 divided by 20 minus 8, and that works out at 1,667. If the number of meals sold is 1,667, then the total sales will be 33,333, and the cost of sales will be 13,333. With the same 25 days per month, I would need an average number of meals per day of 67. Now I can put those numbers into my profit and loss account, sales and cost of sales. Now I need to reality check those figures. Based on the competition, I think the average number of lunches that I can sell is around 30 a day. Evening meals, Monday through Thursday, will be around 20. Depends on the weather. On a Friday and Saturday night, I would expect to be fully sold out. 60 meals. That gives me an average of 63 meals per day, or 1,575 per month. A little bit below the 67 I had calculated to give me my £5,000 ideal profit. When I calculate my new profit and loss account with 1,575 meals, I get a net profit of 3,900. So how can I increase the profit to £5,000 with just an average of 63 meals per day? I could try to increase the average price per meal by approximately 70 pence. I try and get customers to buy a slightly better bottle of wine, something like that. Or I could try to reduce the food costs per meal by 70 pence. Which is harder since 70 pence is a higher percentage of 8 than it is of 20. Lastly, I could try to reduce expenses by £1,100 per month. However, a combination of these three would probably be the best. Well, I didn't buy the restaurant. The price was too high for the potential with just 60 seats. Now it's time to look at what's your ideal profit. If you've got a profit and loss account handy, that would be great. If not, just make a note and look at it afterwards. And anyway, you should know some of these numbers off the top of your head. How much are you paying for fixed expenses per month? For rent, staff, utilities, and any other fixed or overhead expenses? Add up and figure out what your total fixed expenses are. Now let's look at your variable costs, which should be your cost of goods sold. That includes materials, direct labour or subcontractors, shipping and other expenses. This will give you your total variable costs. Sales minus variable costs is your gross profit, and gross profit divided by sales is your gross profit percentage. If you take your ideal profit plus your fixed expenses now, that should give you your ideal gross profit. We're working backwards. To calculate your ideal sales, divide the gross profit by the gross profit percentage. This obviously is an estimate because the cost and expenses are changing all the time. Also, your profit and loss statement may not have costs and expenses split so that you can use them well. For example, all the staff costs might be added together on one line and not split between those who are generating revenue and those who are performing admin tasks. I hope this isn't overwhelming for you. I think I'd better pause here to let you catch your breath and let the radiator cool down. It is normal to be confused and taken aback. If it was easy and obvious, everyone would be doing it, and the failure rate of businesses would not be over 70% in the first 10 years. These concepts and tools take a little time to become familiar with. It's like driving a car. When you start, you feel terrified because of everything you have to do, while all the other drivers seem to be trying to hit you. But once you learn how to drive and practice, it becomes almost automatic. As I promised at the beginning, I'll now share with you how you can have driving lessons with me. There are two ways I work with my clients. Privately one-to-one, where I become like your virtual financial director. This is only for a special few who are in the stage of business where they want to drive their growth and profits to a much higher level. This is an investment of at least £5,000 for 6 months. A lot of you will prefer to start with a lower investment, and that's why I've launched my online course called Master Your Money. Master Your Money was designed for business owners who want to drive profitable businesses without having to worry about running out of cash. So if this is you, you will learn basic financial concepts and how to implement them so that you can make accurate projections for cash, sales, profits and personal income. This is an online course and will start at the end of February and will be spread over 8 weeks with videos, audios, a downloadable workbook, practical exercises and, most important of all, live Q&A calls to check up on how you're progressing with the material and to clear any doubts. Here's a summary of the content we will be covering. We start with a pre-module to get you up and running. This module 0, Run Diagnostics, finding out where you want to go. Is your business model the best to get you there? It's to plan your route, check the oil, water and tyres, fill up the tank and get going. Module 1, the rearview mirror. Do you run the business based on the past? Can you just look at what lays ahead view and ignore what has happened up until now? Accounting reflects your company's performance and is an important element for efficiently running your business. Module 2, Oil in the Engine. Without cash, you will blow your engine, no matter how good a product or service you have. Understanding how to keep the machine oiled and running smoothly so it can grow steadily and safely is really important. Module 3, Miles per Gallon. How do you measure performance? Your revenue expenses need to be monitored so that you don't compromise profitability. Module 4, Gauges. An overview of your assets and liabilities, the danger of taking them at face value, and how to leverage your business. Module 5 is Assembly, putting it all together. How do all the financial statements really fit together? And here we get to understand them and how they can help you make informed decisions in your business. Module 6. This is turbocharging. How to speed up growth by managing your assets, improving your cash flow and profitability. Module 7 is the dashboard. How to upgrade your understanding of your business by using a combination of financial and non-financial metrics. The final module 8 is the onboard computer. How to eliminate the guesswork and have budgets and forecasts that will guide the growth of your business. Now you may be thinking, I don't have time for this, but this is not an accounting course. This is how to understand and use your accounts to plan and leverage your business. You'll be amazed how, as it happened when you learned to drive, everything will become easier and you won't be in the same danger of crashing or running someone over. Plus, you will have more time and more money to do the other things you enjoy. After all, life is more than just business and yours should be working for you instead of the other way around. So now you must be thinking, how much is this going to cost me? First, it is not a cost, it's an investment. It's £997, but this is not the price you're going to have to pay for. I'll tell you about that later. You'll be amazed how, as it happened when you learned to drive, everything will become easier and you won't be in the same danger of crashing or running someone over. Plus, you will have more time and more money to do the other things you enjoy. After all, life is more than just business, and yours should be working for you instead of the other way around. So now you must be thinking, how much is this going to cost me? First, it is not a cost, it's an investment. It's £997, but this is not the price you're going to have to pay. I'll tell you about that later. What is the value of a business? What is my business really worth? Now you might be thinking, isn't that what a balance sheet tells me? Well, not exactly, and only then if you use what is known as an asset approach for valuing a business. Plus, balance sheets change each day. Let's look at a balance sheet. To make it easier to read, I've used old-style horizontal format with assets on the left and liabilities and shareholders' equity on the right. It's the total shareholders' equity that represents what the company is worth to the shareholders. However, the balance sheet is a historical document with a lot of items at original cost. So assets have to be revalued at today's realizable value. We also have to consider the risks that the business has of not being able to pay suppliers or repay loans, which might mean more money needs to be put into the business. You can usually tell how risky a business is by comparing the total current assets and the total current liabilities. In this case, the business looks quite healthy, 43,800 versus 35,050. This is the current ratio, and anything over 1 is good. But this isn't the whole picture. If you compare the cash and accounts receivable with the accounts payable and taxes payable, you can see that the business is not very healthy. This is known as the acid ratio. The nature of the business is important. It looks like a lot of sales may be to the public for cash, and there is a delay before paying suppliers. Inventory looks like it might be high compared to the value of accounts payable. So there may be some problem with the valuation, and some old slow-moving inventory may need to be written off. Let's suppose we have 5,000 to be written off. Now let's look at the property and equipment. The land and buildings may not have been revalued for some years. Let's suppose that the real value is 115,000, which is an increase of 43,000. With the assets approach, we take the shareholders' equity, subtract anything that needs to be written off, like the inventory, and add the increase of any other assets, like the land and buildings, 43. This gets us to a valuation of 76,750. However, few businesses are valued just on the assets, unless the business is going to be closed and the assets sold. That's the breakup value. So the next method of valuing a business is the market value. Market value is straightforward. It's based on what similar businesses have been sold for recently. Even so, location, transportation links, parking, etc. can have a significant impact on what the business is worth without an objective basis for calculation. The net profit approach is rather different in that you're looking at the expected future earnings from the business. It will depend on how many years you're prepared to wait to recover your investment, and in this case, let's look at a profit and loss account for a fictitious company that shows a net profit after tax of 85,400. The business might have some risks, so we want to get our money back in just 3 years instead of a normal 5 to 10 years based on the particular industry. If the business had some assets that could be sold, this would change the valuation and all three evaluation methods might be checked before coming to a final figure. Obviously, a seller of a business may use one approach with certain assumptions, while a buyer may use a different approach and also different assumptions. Now we've covered how come I have nothing in the bank, how do I make a profit, and what is my business worth. Just to give you a couple of examples, when I was working with a restaurant chain, they never had anything in the bank. The business model was immediate cash from customers and paying suppliers after 30 or 60 days without very much inventory. That meant that they always had cash coming in fast and they tried to make cash go out slowly. They used this surplus cash to open new restaurants, which meant they were always adding potential. They also negotiated hard with shop fitters and kitchen equipment suppliers, etc. How they made a profit was by getting very good prices from the suppliers because of the quantities that they were buying. Also, adding more restaurants meant that they could share staff and control staff costs. Opening a new restaurant with experienced staff resulted in becoming profitable quicker. Restaurants were benchmarked and best practices shared so that each restaurant was well controlled and as profitable as possible. I helped them set up monthly budgets and reporting and train the managers. Any variations from budget had to be explained by the managers. For example, the average food cost had to be 30 to 32% for a larger restaurant and 35% for a smaller one. Regarding what is the business worth, they were buying restaurants, not selling, and they valued the restaurant based on the net profit approach. They estimated how many meals they thought they could serve. They knew the costs and expenses, so they could check the break-even and forecast future profits. Since they usually altered the layout and bought new equipment, the asset value was irrelevant, as was the market value, since they were interested mostly in the profit potential with their concept.